Welcome to Tech Money Madness, your daily U.S. stock market podcast, March 25, 2026.
Glad to be here.
So imagine looking at a dashboard where the speedometer is it's pinned at a record-breaking 150 miles per hour.
Right.
But right next to it, the check engine light is flashing bright red. That is essentially the U.S. economy today.
It really is, yeah.
Our mission on this deep dive is to try and make sense of a market that feels like it's living in, well, two completely different realities.
Exactly.
Because on one hand, you have this explosive, euphoric rally, and on the other, you have some very real, very bright economic warning lights flashing for the everyday person.
Yeah, the contrast is honestly pretty jarring.
It is. So let's start with the headline numbers because they are striking. The Dow Jones Industrial Average surged 356.75 points today.
Massive move.
Yeah, closing at an impressive 46,480.81. And we're seeing basically two primary catalysts driving this upward momentum right now.
Right, the economic data and the geopolitical side.
Exactly. The first is a wave of optimistic economic data hitting the wire. And the second, and this is perhaps even more impactful for market psychology today, are the growing whispers of a potential peace proposal emerging in the ongoing Iran conflict.
Yeah, and the headline number, that 356-point surge, it looks fantastic on the surface.
It looks great.
It does. It gives you this impression of broad, sweeping market health. But if you really want to understand what happened today, you have to look under the hood.
Because it's not the whole story.
Not at all. The real story here isn't just a rising tide lifting all boats equally. I mean, it is a highly concentrated rally in the tech sector.
Okay.
The Dow's performance is, well, it's a billboard. But the underlying engine of today's market action is almost entirely driven by technological innovation and, frankly, some radical corporate restructuring happening within the world's biggest companies.
Okay, let's unpack this. Because if tech is the engine, the fuel right now is unquestionably artificial intelligence.
Oh, without a doubt.
And today, we saw a really notable development in the AI hardware space. ARM just debuted its brand new AI CPU.
Huge deal.
Yeah, and they aren't just dipping their toes in the water here. They are aggressively going after a $1 trillion AI CPU market.
Trillion with a T.
Trillion with a T. And what caught my eye in the reports today wasn't just, the tech specs of the chip, but the client list they rolled out.
Right. They came out swinging.
They really did. They've already secured foundational clients for this new hardware. We're talking Meta, OpenAI, and Cloudflare.
Yep.
But before we get to the clients, help me understand the hardware side of this, because we've heard so much about GPUs, graphics processing units, driving the AI boom over the last few years.
Right, the whole NVDA narrative.
Exactly. So why is ARM making a CPU a central processing unit, and why on earth is it a $1 trillion deal?
So that distinction is actually the key to understanding ARM's breakthrough here. For the last few years, the entire AI industry has been intensely focused on training models. When you want to teach an AI to understand language, you have to feed it billions of documents.
Right.
And that requires massive parallel processing, which GPUs are perfectly designed for. They handle thousands of tiny tasks at once.
Okay, that makes sense.
But once a model is trained, it enters a totally different phase called inference.
Inference?
Yeah. That's when you, the user, actually ask the AI a question, and it generates an answer.
Oh, gotcha.
And running inference on heavy GPUs is incredibly expensive.
Yeah.
And it's so power hungry. I mean, the energy draw is insane.
So ARM is fixing that.
Exactly. ARM is stepping in with a specialized AI CPU designed specifically to run inference highly efficiently.
Wow.
Yeah, by securing OpenAI and Meta, ARM is essentially positioning itself at the foundational layer of the next decade of computing.
Because everyone's going to be running inference all day long.
Right. The power grids in these data centers are maxing out as we speak. So whoever provides the most energy-efficient processing units to actually run these AI models day to day, that company is going to capture the foundational market share of a $1 trillion industry.
Which brings us to one of ARM's biggest new customers, which is Meta.
Yes.
And Meta was today's most active stock. The sheer volume of news surrounding them today is substantial.
It's a lot to process.
It really is, because they are paying a heavy internal price to fund this AI ambition. Meta just announced severe layoffs across several major departments.
Very severe.
Yeah, specifically targeting Reality Labs and Facebook, just so they can refocus almost exclusively on artificial artificial intelligence.
A complete pivot.
And this is all happening, by the way, on the exact same day they are dealing with the fallout of a jury verdict in their social media addiction trial.
Which is rough.
Yeah, it adds a whole layer of regulatory headwind to their core business. But looking at these layoffs, I mean, I have to push back on their strategy here a little bit.
Oh, really?
Yeah, because Mark Zuckerberg burned billions of dollars chasing the metaverse through Reality Labs.
Tens of billions, yeah.
Right. And now they're just slashing those teams. Is Meta essentially tearing down a multi-billion-dollar house Reality Labs just to build a giant AI server farm in the backyard?
That's one way to look at it.
I mean, are they abandoning their past too quickly? Why should investors trust that this pivot won't end the exact same way the metaverse pivot did?
Well, what's fascinating here is how the market is rewarding that exact ruthlessness.
They like it.
They love it. To answer your question about tearing down the house, yes, they absolutely are. But the market believes it's the right move this time.
Why, though? What's the difference?
Because for years, Reality Labs was basically a passion project. The metaverse was supposed to be the future, but it required consumers to buy these bulky headsets and fundamentally change how they interact online.
Right, the friction was just way too high.
Exactly, the friction was massive. But AI is completely different. The capital expenditure required to pivot to AI is astronomically high. I mean, buying all those ARM CPUs and servers costs billions.
Sure.
But Meta is looking at the landscape and realizing that the return on investment for AI is tangible right now.
Like today.
Yes, today. They don't need to convince you to wear a headset anymore. They just embed AI into the Instagram algorithm to keep you scrolling longer and to target ads better.
Oh, so it's invisible to the user.
Completely invisible,
Okay.
but highly profitable. If you want a perfect example of why Meta is willing to inflict this kind of internal pain to fund AI development, look no further than Palantir Technologies today.
Right, Palantir was the other major tech story of the day.
Unbelievable numbers.
Truly, they just released numbers that are honestly hard to wrap your head around. They reported a 70% revenue increase in their last quarter.
70%.
Yeah.
For a company that size, it's wild.
It's staggering. But again, I don't just want to read the numbers off a sheet. What are they actually selling that justifies a 70% jump in revenue?
So Palantir serves as the ultimate proof of concept for the rest of the tech sector.
Okay.
Because they are proving what happens when enterprise AI leaves the cute chatbot phase
Yeah.
and enters the real operational phase.
So it's not just writing emails for you.
No, not at all.
Yeah.
Think of Palantir's AI not as a text generator, but as an operating system for a deeply complex business. Like, say, a major hospital network.
Okay. Tracking patients and stuff.
Exactly. Their software ingests real-time data on patient intake, nurse staffing schedules, ambulance routing, medical supply chains, all of it.
Wow.
And then it predicts bed shortages before they even happen and automatically optimizes the staff shifts.
That's incredible.
Right. That isn't a theoretical parlor trick. That saves a hospital network millions of dollars a single month.
Then that's where the 70% comes from.
Exactly. That tangible utility is why their revenue jumps so high. Palantir is proving that if you provide software that fundamentally changes how businesses and governments actually operate, the financial returns are immediate.
So Meta sees that and wants a piece.
Yes, that revenue jump is the exact justification Meta needs for its ruthless restructuring. There is actual massive revenue to be captured if you build the right infrastructure now.
Here's where it gets really interesting, though.
Okay.
We've been talking about the virtual frontier AI, software, large language models, all that. But today, the market also went completely parabolic over the physical frontier. Space. We got reports today that SpaceX is reportedly preparing for an imminent IPO filing.
Huge news.
And this news, it basically single-handedly sent the entire space sector straight into orbit. I'm looking at today's top gainers, and it's basically a who's who of space exploration and satellite tech.
AST, Space Mobile, Rocket Lab.
Exactly. AST Space Mobile, Rocket Lab, Firefly Aerospace. They all saw sharp rallies today, just off the gravitational pull of these SpaceX IPO rumors.
Yeah, it's a classic sympathy play in the markets. And it's driven by this concept of TAM, or total addressable market.
Right.
Right now, space is viewed as a boundless frontier.
Yeah.
The TAM for commercial space flight, satellite internet, asteroid mining, I mean, it feels infinite to investors.
Because no one knows where the ceiling is.
Exactly. So when an undisputed titan of an industry like SpaceX signals it's going public, it completely validates the entire sector in the eyes of institutional money.
Right.
Before an IPO, space is speculative. But once a company like SpaceX files, portfolio managers suddenly have a benchmark valuation. they can actually model the math.
Oh, I see.
Yeah, so when the market hears SpaceX is going public, capital just floods into AST, Space Mobile, and Rocket Lab because institutional investors are suddenly desperate to establish their required exposure to the space economy.
They don't want to miss the boat.
Exactly. But, and this is crucial to remember when we look at your own portfolio, for every company reaching for an infinite frontier today, there is a company crashing back down to earth in a saturated one.
Yeah, that's a good point.
We really have to look at the losers to get a balanced picture of what's happening.
And the undisputed top loser today was a former darling of the tech world, Peloton Interactive.
Ouch. Yeah.
It's almost whiplash, seeing the space stocks surge while Peloton just plummets.
Well, Peloton is suffering from a very harsh reality check regarding their business fundamentals.
Right, the pandemic is over.
Exactly. During the pandemic, they had a captive audience. But today, the core issues are glaringly obvious to the market. They simply lack a competitive moat.
A moat, like around a castle.
Right. A moat is a distinct advantage that protects your market share from competitors. Like Palantir has a moat because hospital networks are deeply, deeply integrated into their proprietary software.
It's hard to rip out.
Exactly. But Peloton makes an exercise bike with a screen attached.
Right.
There is absolutely nothing stopping competitors from offering cheaper hardware and similar streaming classes.
Yeah, anyone can make a bike.
Combine that complete lack of a moat with continuously bleeding membership numbers, and you have a stock that investors are just sprinting away from.
Makes total sense. And speaking of streaming and struggling to prove value, Roku also took a noticeable hit today.
Yeah, down 2.5%.
Down 2.50% amidst some broader tech sector weakness. But what confuses me here is that Roku actually had what looked like good news today.
The Prime partnership.
Right. They are launching their Howdy streaming service on Prime Video, which expands their reach way beyond their own hardware platform.
Yes.
So I have to push back a bit on your theory of how markets react to news here. Why does an unconfirmed rumor lift all the boats in the space sector? But Roku's actual, tangible, strategic partnership with a giant like Prime Video couldn't save its stock from sliding today.
That is a brilliant question, and it comes perfectly back to the difference between a nascent market and a saturated market.
Okay, tell me more.
The space sector is a boundless frontier. The pie is perceived to be growing rapidly. Roku, on the other hand, is operating in the streaming hardware and platform space, which is brutally saturated.
Everyone has a streaming stick now.
Exactly. So expanding the Howdy service to Prime Video is a good strategic move on paper, sure. But the market views it as a defensive surrender.
A surrender.
Yeah, when Roku puts its channel on Amazon's platform, they are sharing viewer data and giving up a cut of the ad revenue to Amazon.
I see.
It's Roku trying to survive in a war against Apple, Amazon, and Google by conceding territory. A partnership doesn't change the fundamental fact that their core business faces intense, margin-crushing competition.
So the investors see right through it.
Exactly. In a saturated market, good news is often just seen as treading water to delay the inevitable.
Wow. Okay, so we have this high-flying reality of AI, trillion-dollar ship market, space IPOs, but then there is the other reality we mentioned at the start of the deep dive.
The check engine light.
The flashing check engine light, the ground-level economy.
If we connect this to the bigger picture, you have to realize that launching rockets and running AI data centers share one fundamental requirement:
Power.
enormous amounts of physical energy. And right now, the global supply chains that provide that physical energy are under severe threat.
Right.
The ongoing conflict in Iran is causing tangible bottlenecks that are starting to ripple through the market, proving that you really can't build a digital utopia if the physical supply chains are broken.
Right, and we need to look at these geopolitical developments purely through the lens of how they are impacting the markets and the supply chain.
Absolutely.
The blockage of the Strait of Hormuz is the critical choke point here. And from the reports we're seeing, this isn't just about crude oil anymore.
No, it's spreading.
The blockage is choking off the transport of other vital foundational commodities, particularly liquid natural gas and fertilizer.
Which directly impacts global food prices.
Obviously.
Because modern agriculture is entirely dependent on global fertilizer shipments. When you choke off fertilizer at a choke point like Hormuz, agricultural yields drop.
Which means less food.
Exactly.
Yeah.
That means 6 months from now, the cost of basic food staples at your local grocery store rises.
Yeah.
But the immediate fallout is being felt most acutely in transportation and logistics today. Because of the rising oil prices caused by the Iran war and this blockage, the U.S. Postal Service is now seeking an 8% fuel surcharge for package deliveries.
An 8% surcharge. I mean, think about what that means for you listening right now. If you're running an Etsy shop out of your garage or a small e-commerce business, that 8% surcharge isn't just a headline on a financial terminal.
No, it's real money.
It's a direct hit to your margins starting tomorrow. It's a massive inflationary pressure injected directly into the veins of the everyday economy.
Exactly. And we are seeing immediate policy reactions from the government to try and blunt that impact.
Like the gas waiver.
Right. The Trump administration has just waived gasoline regulations specifically to prevent a fuel supply disruption and to try and address these surging fuel prices at the pump.
And let's break down the mechanism of that waiver for a second, because it's not just a wave of a magic wand.
No, it's a specific regulatory move.
Right. Refineries typically have strict environmental regulations requiring them to produce specific summer blend fuels that reduce smog. But those blends are much more expensive and complex to refine.
Much more.
By waiving those regulations, the administration is essentially easing the constraints on the refineries, allowing them to produce cheaper, dirtier fuel just to keep the physical supply high and the prices down at the pump. It's an emergency valve being released.
It is, but it's a temporary fix. Citrini Research put out a very stark warning today.
What'd they say?
They are cautioning that these persistently high energy prices are going to act like a heavy anchor on both consumer wallets and corporate earnings.
Makes sense. If I'm paying more for gas, I can't buy other stuff.
Exactly. If everyday consumers are paying significantly more to fill up their cars and mail packages, they simply have less discretionary income to spend on the goods and services that drive broader corporate profits. Citrini is warning that this creates an incredibly tough macroeconomic backdrop for equities, regardless of how well the AI sector is doing.
And amidst all this supply chain chaos, there are also some major diplomatic and economic maneuvers happening in the background that could reshape the global trade map.
Definitely.
The White House announced today that President Trump will be traveling to China to meet with Chinese President Xi Jinping this May.
A very highly anticipated meeting.
Huge. That is a long-awaited meeting, and the trade implications of those two sitting down at this specific moment in the global economy are monumental.
Because the relationship between the U.S. and China dictates the flow of global technology, manufacturing, and capital.
Pretty much everything.
Yeah. Any signals regarding tariffs, trade agreements, or technology export controls coming out of that May meeting will instantly reprice entire sectors of the market.
Wow.
Especially when you consider how reliant companies like ARM and Meta are on Taiwanese semiconductor manufacturing, which is obviously heavily influenced by U.S.-China relations.
And closer to home, but really no less significant, the U.S. just brought back $100 million in gold from Venezuela.
Physical gold.
Physical gold.
Yeah.
The Interior Secretary noted today that Venezuela's interim president is actively seeking foreign investment in their mining sector. So you have this scramble for hard assets and physical resources happening on a global scale.
Everyone's grabbing what they can.
Everyone is trying to secure the physical materials required to run tomorrow's economy. But bringing this all back home, let's talk about the listener for a second.
Okay.
So what does this all mean? If you were trying to buy a house or start a small business or just manage your retirement account, how do you reconcile Dow 46,000 with 8% postal surcharges?
Well, the translation for the everyday consumer right now is difficult because the data paints a picture of a severe squeeze.
Yeah.
Let's look at the housing market. Mortgage demand just plummeted over 10%.
10%, that's a huge drop.
Why? Because mortgage rates have hit their highest level since October. Affordability, which was already strained, is weakening even further.
Right.
The average person is being priced out of the housing market at the exact same time their everyday expenses, like fuel, food, and shipping, are going up.
And that's exactly why we're seeing the narrative on Wall Street start to shift beneath the surface of these record index highs.
People are getting nervous.
Wall Street economists are actually hiking their recession odds today. They're looking at a slumping labor market, they're looking at this geopolitical uncertainty with Iran, and they're pulling forward their risk assessments for an economic contraction.
Right.
It's this bizarre scenario where the stock market is celebrating an unconfirmed peace rumor, but the actual economists running the spreadsheets are preparing for a recession.
This raises a really important question about where the hidden risks lie in the financial system. And the most critical warning signal we're seeing today is in the private credit sector.
Let's define private credit for the listener real quick, because it's a term thrown around on financial TV a lot, but not everyone knows what it means.
Sure.
After the 2008 financial crisis, traditional banks got much stricter about lending money to risky, mid-sized businesses. So, private equity firms and investment funds stepped in to fill that gap. They
Exactly.
lend money directly to these companies,
Right.
completely outside the traditional banking system. That is private credit.
Right. And for years, private credit was viewed as this high-yield, perfectly safe haven.
Can't lose.
Yeah, investors operated under what the reports today called a zero-loss fantasy. Because interest rates were essentially zero for a decade, these mid-sized companies could easily afford their loan payments.
Right, money was free.
But private credit loans usually have floating interest rates. So when the Federal Reserve hiked rates to fight inflation, the monthly debt payments for these companies doubled or tripled.
Oh, man. Which means the era of the zero-loss fantasy is officially over.
Dead and gone.
Investors are now aggressively pulling their money out of the private credit sector because defaults are beginning to surge.
Because private credit acts like the shock absorbers on a car.
Okay.
For years, they've smoothed out the bumps of a volatile economy by providing easy liquidity to businesses that couldn't get bank loans.
Yeah.
But with interest rates staying this high for this long, those shock absorbers are finally bottoming out.
They're snapping.
Exactly. The surge in defaults shows that the pain of high interest rates and high energy costs is finally breaking the weaker players in the corporate world.
Right.
When businesses default on private credit, they lay off workers, which hits the labor market, which reduces consumer spending. It's just a vicious cycle.
It really forces you to step back and look at the sheer contrast of the deep dive we just went on.
Yeah, it's wild.
Because on one side of the ledger, you have Wall Street hitting absolute record highs, fueled by visions of a trillion-dollar AI ecosystem, Meta's corporate transformation, and the dreams of a SpaceX IPO.
The future looks incredibly bright.
Hyper-efficient and boundless. But on the exact same day, Main Street is getting hit with an 8% package surcharge from the USPS, a 10% drop in mortgage demand as homeownership slips further out of reach, and a private credit market where the shock absorbers are failing and defaults are surging.
It is a market of two completely divergent realities.
For sure.
The technological ceiling has never been higher. I mean, we are building systems that can predict hospital needs and run trillion-parameter language models efficiently.
Unbelievable stuff.
But the economic floor for the average consumer is starting to crack under the heavy pressure of inflation, high interest rates, and geopolitical strain.
Which leaves us with one final puzzle to chew on before we wrap up today.
Let's hear it.
If tech giants like Meta and ARM are successfully building the hyper-efficient, AI-driven economy of tomorrow, an economy that promises to revolutionize productivity and completely change how businesses operate, will those productivity gains arrive fast enough to save you, the everyday consumer, from the harsh physical world recession that is threatening us today?
That is the trillion-dollar question.
Or will the rockets simply run out of physical fuel before they can reach orbit? That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.